If you think Walmart is just a discount store that sells cheap products, you're analyzing the wrong business. The low prices on the shelves are the visible product, but the real power sits in what Walmart controls behind the scenes. That power isn't the price tag itself. It's the supply chain, the supplier economics, and the physical infrastructure that quietly makes those prices sustainable at scale. When you walk into a Walmart, you see rollback signs, wide aisles, and shelves stocked with everyday essentials. What you don't see is the network of distribution centers, trucking fleets, long-term land positions, and supplier contracts that coordinate every product before it reaches that shelf. That hidden infrastructure isn't support. It's leverage. So here's the real question. How do you generate more than $650 billion in annual revenue while operating on margins that appear razor-thin? The answer has far less to do with pricing strategy and far more to do with structural control. To understand that control, you have to go back to Sam Walton. In the 1940s, Walton ran a small Ben Franklin variety store in Newport, Arkansas. He wasn't trying to dominate national retail. He was trying to win locally by being more efficient than competitors. Walton believed that consistently lowering prices would build loyalty, and that higher volume would unlock negotiating power with suppliers. That simple loop, lower prices leading to higher volume leading to stronger leverage, became the foundation of the model. In 1962, Walton opened the first Walmart in Rogers, Arkansas, targeting small-town America rather than major metropolitan areas. Smaller markets allowed Walmart to cluster stores regionally, creating operational density before expanding outward. That density became strategic leverage because it allowed Walmart to control distribution routes and supplier relationships within concentrated geographic footprints. Early on, Walmart eliminated middlemen and purchased directly from manufacturers whenever possible. Removing wholesalers wasn't just about shaving costs. It was about controlling the cost structure at its source. Then came one of Walmart's most important operational breakthroughs: cross-docking. Instead of storing inventory for long periods, goods were transferred directly from inbound trucks to outbound trucks with minimal warehousing time. This reduced storage costs, accelerated turnover, and minimized capital tied up in excess inventory. What appeared to be a retail chain was becoming a logistics system with retail storefronts attached. Through the 1970s and 1980s, Walmart expanded aggressively across the United States and eventually became the largest retailer in the country. But scale introduced tension. As Walmart grew larger, its suppliers also grew larger and more sophisticated. If suppliers controlled pricing structures, production schedules, or shipping timelines, they held leverage over Walmart's margins. That leverage threatened the entire low-price promise the brand was built on. So what do you do when your partners begin to dictate economics to you? You redesign the structure so that leverage flows in one direction. Walmart centralized purchasing authority and standardized supplier requirements across its network. Shelf space stopped being automatic and became conditional on strict cost discipline and performance metrics. If you wanted access to Walmart's scale, you agreed to Walmart's terms. That was the structural flip. Walmart didn't just negotiate harder. It built infrastructure that made suppliers dependent on participation. Over time, that dependency became self-reinforcing. Today, Walmart operates the largest private truck fleet in the United States and controls thousands of stores supported by strategically located distribution centers. These assets are positioned near major population hubs to optimize delivery time and reduce transportation costs. Real estate density reinforced cost efficiency and increased bargaining power simultaneously. If you control how goods move, where they move, and how quickly they move, you influence more than pricing decisions. You influence supplier behavior, capital allocation, and long-term margin stability. Sam Walton frequently emphasized cost discipline at every layer of the system, because he understood that shelf pricing is only the surface expression of deeper structural economics. To make this clearer, break the model into 3 layers. The visible layer is what customers see: large format stores, everyday low prices, and broad assortment. This is the competitive face of the business. The operational layer is what managers and employees manage daily: staffing levels, shrinkage, inventory turnover, and local competition. This is where execution happens and volatility lives. The leverage layer sits beneath both. Supplier economics control, logistics dominance, real estate ownership, and data infrastructure form the core engine. This is the layer that determines durability and long-term advantage. Walmart's Retail Link system provided suppliers with real-time sales data and performance transparency. While this improved efficiency across the network, it also allowed Walmart to define the performance standards suppliers had to meet. If a product slowed in velocity, shelf space could shrink quickly, and if a supplier resisted cost targets, volume could shift to competitors within the system. Pause and consider what that means. Walmart wasn't simply selling products to consumers. It was governing the operating environment suppliers had to compete within. Now, look at the scale. Walmart generates more than $650 billion in annual revenue, with roughly 60% derived from U.S. operations. Its purchasing relationships span thousands of suppliers globally, giving it unmatched negotiating leverage. Beyond retail sales, Walmart collects billions annually in allowances, rebates, and performance-based contributions tied to placement, promotion, and visibility. These flows are not incidental. They represent structural, recurring income embedded within supplier relationships. Retail margins may appear thin on the surface, often just a few percentage points, but the leverage layer produces returns that are more stable and predictable than pure retail markup alone. That structural difference explains why Walmart's scale translates into durability rather than fragility. Here is the escalation. If a supplier wants national distribution, Walmart controls access to that reach. If a supplier depends on Walmart's volume to sustain production, Walmart dictates pricing structure. If a supplier needs shelf visibility to compete, Walmart determines placement terms. That asymmetry defines dominance. Now step back and examine durability. Walmart's asset base includes thousands of owned or long-term controlled properties, along with distribution centers and logistics infrastructure that would take decades to replicate. That physical network has strategic value independent of any single product category or seasonal trend. Even as e-commerce reshaped retail, Walmart integrated its store network into last-mile fulfillment capabilities, turning physical locations into hybrid retail and distribution nodes. Infrastructure became optionality. Every new store strengthens supplier leverage, and every additional distribution center reduces delivery cost across the network. Lower cost supports sustainable pricing power, which increases traffic and deepens supplier dependency within the system. The economics reinforce themselves over time. If you analyze Walmart purely as a discount retailer, you see price competition and narrow margins. If you analyze Walmart as a logistics and supplier control platform, you see structural power built on infrastructure and negotiated economics. Which framework better explains decades of resilience across retail cycles? New competitors cannot quickly replicate supplier integration, distribution density, and real estate scale without investing enormous capital and time. Suppliers cannot easily exit Walmart without sacrificing massive volume exposure, which stabilizes Walmart's negotiating position across economic conditions. Most people analyze what Walmart sells. Sophisticated observers analyze what Walmart controls. When you shift your lens from merchandise to infrastructure, Walmart's dominance stops looking accidental and starts looking engineered. It becomes the predictable outcome of structural design. Walmart does not simply compete on price, it governs a system built on scale, data, logistics, and negotiated leverage. If this changed how you see the company, subscribe to follow the series as we continue dissecting leverage architecture behind major corporations. Drop a comment with the next company you want analyzed, and let's keep uncovering what most people overlook. Walmart doesn't just sell products. It controls the pathways those products travel. And that control is the real business.